Fund Supermart, your online gateway to unit trusts.
What is your outlook for the US equity market for the remainder of 2015? Do you think there will be rising market volatility over the next few months?
So we remain pretty optimistic on the U.S. equity market, both for 2015 and then also for our longer-term investment time horizon. When we look at the market overall, we think that the two pillars of the economy are still in pretty good shape, both the consumer and the enterprise. On the consumer side, we're seeing employment growth, unemployment coming down, wages start to increase, seeing a little bit of wage inflation overall. Consumer spending is pretty good. We have a relatively under-levered consumer, and we're finally starting to see the housing market continuing to move in the right direction. On the enterprise side of things, we see record corporate profits in the United States, really lean companies, which means they're generating huge free cash flow overall. Companies continue to increase their dividends, buy back shares, and now we're also seeing a pretty robust mergers and acquisition environment, which leads to increased earnings growth as companies wring out costs. So overall, both on a short-term basis and a longer-term basis, we're finding a lot of opportunities in the U.S. On the volatility side of things, we have been talking about the possibility of increased volatility in the U.S. as the Federal Reserve contemplates increasing interest rates. It's our view on a longer-term basis that interest rates are going to rise gradually, and it'll still be an accommodative environment overall for U.S. equity investors, but the uncertainty around the timing of Fed interest rate increases could cause more volatility. That wouldn't surprise us if there was more volatility through the end of the year. So we haven't specifically identified whether or not we think it's going to be September or December. There's a lot of controversy or discussion in the markets around when that's going to be. I think that the more important thing is, from our opinion, that when they start to increase rates, they're going to do so in a gradual manner. They likely won't increase rates meeting after meeting after meeting, and generally we're going to have accommodative monetary policy for an extended period of time, which in the past has still been pretty good for U.S. equity prices.
What will be the drivers and risks to performance?
Right, so on the positive side, we think that we'll continue to see good returns in the market if we have an environment of moderate economic growth in the U.S., low interest rates, low inflation, earnings continue to move in the right direction, really strong free cash flows. As long as we have an environment that's been pretty similar to what we've seen over the last 2, 3, 4 years, which has all been very positive for the U.S. equity investor, then we think that that will be a positive driver for performance. On the negative side of things, our group's talked a lot about the geopolitical risks that are out there, be it Greece or emerging markets or China. It's our view that those things are unlikely to derail the U.S. picture. There's also been a lot of discussion in terms of a slowdown in earnings in the United States. Earnings growth overall for the market has been pretty flat this year, mostly due to energy earnings coming in significantly, but then also a stronger dollar overall. We've found pockets of opportunity in terms of technology and healthcare and consumer discretionary, so we're finding opportunity overall, but there are people that look to a slower earnings picture as well as fullish valuations as being risks. We still are seeing opportunity in the marketplace, but those are some of the things that we're talking about right now.
Which do you favor more at the moment, US large or small caps, and why?
Right. So when you look at our portfolio as a whole, we're large cap in focus, but what we call the sweet spot of investing, where we're really finding a lot of opportunities, is in the $5 to $25, $5 to $30 billion market cap range. So companies that are mid cap that are moving into large cap, that's generally where we find our opportunities. We like to find leading companies, number one and number two players that we think can be significantly larger over time. So that generally directs us towards that $5 to $25 or $5 to $30 billion range, because those companies have the best growth prospects. On the small cap side of things, some of those valuations are okay, some of them are maybe a little bit stretched, so it's a little bit mixed there. And then on the mega cap side, we generally have underweight to the large mega cap slow growth types of companies. We tend to focus more on companies that have significantly faster earnings growth prospects.
Where do you find the most promising opportunities? Are there any sectors that are likely to do better this year?
So the sectors where we have the most weight in our portfolios, as well as the most overweight versus the market overall, are technology, healthcare, and then consumer discretionary. Those are the three areas where we're finding the most opportunity. On the technology side, we are generally invested in the newer types of faster growing technologies, be that internet or software as a service, cloud, semiconductor companies. That's generally where our emphasis is, and we tend to have less emphasis on the legacy types of slower growth technology companies. On the healthcare side, it's a pretty good mix of biotechnology companies, mostly large cap biotech companies that have proven growth business models. They already have products that are out in the marketplace. They're seeing significant growth, but in our opinion have pretty quick or fast growth prospects going forward and really, really clear earnings visibility over the next 3 to 5 years. So that's one part of the healthcare bucket. But then we also have pretty good representation in specialty pharma, tools companies, and a lot of different areas of healthcare. So technology and healthcare are the two areas where we have the largest weights in our portfolio, but we're also finding some opportunities in the discretionary space and have a decent weighting in that area as well.
What are the biggest challenges and concerns that you face during stock picking?
So our focus is on long-term ideas, bottom-up fundamental type of research. And so what we really try to do on our team is we try to identify 3 to 5 year type of long-term growth opportunities, and really companies that we think that the market isn't really appreciating the growth prospects for those businesses. The challenges come in where a lot of market participants are much more short-term focused than we are. They're much more focused on, say, individual company news on a quarter-by-quarter basis, or what's the latest headline on Greece, what's the latest headline on Europe, what's the latest headline on emerging markets. And the short-term focus causes a lot more volatility in the market overall, a lot more volatility on a short-term basis, but the opportunity comes in looking at companies and saying, this company has solid, good prospects over 3 to 5 years, really long-term, sustainable types of earnings growth. And if we can identify those companies, then that's where the opportunity is. But there is a lot of short-term noise out there and a lot of market participants that do create a lot of volatility in the market that really causes a lot more movement on a short-term basis that does present challenges.